Welcome, everyone. Thank you for being with us for actually it's becoming our annual uh, session on looking for the best investment ideas and themes for this year, which is 2022. And as the title says, it's not, this session is not going to be for like completely just making recommendations on specific stocks, but rather I'm looking at giving you a theme and ideas, not only for 2022, but actually beyond that. So it could be a decade of the 20s. So that's the purpose of this. So the way we're going to approach this, we're going to look a little back to where we were, what were the expectations, and then take it from there and look at the themes, but also look at the macro economy, and based on that, build those themes. And then hopefully we get some productive and profitable ideas from our session for next hour and a half. So again, the best investment ideas and themes, not the stocks, it's just ideas. And before I start, it's important, especially with the pundits on TV and the Wall Street gurus and all that. I thought, let's start with this. Some of my heroes, four of the, graded investment minds in the world. So I start with Benjamin Graham, the father of the security analysis. He says, I'm skeptical about stock market forecasting by anybody, and particularly by bankers. And then John Templeton, my hero, he says there will be a bear markets about twice every 10 years and recessions about twice every 10 or 12 years, but nobody has been able to predict them reliably. So the best thing to do is to buy when shares are thoroughly depressed, and that means when other people are selling. And I think this is an important factor, and I think it will be part of our theme today, as you will see. And then Peter Lynch says there are economic facts and there's economic predictions, and economic predictions are a total waste. And the last but not least, of course, our Oracle of Omaha, Warren Buffett. I make no attempts to forecast the general market. My efforts are devoted to finding undervalued securities. So with that in mind, let's look at why even I'm mentioning this. The reason is, again, every year, beginning of the year or toward end of the year, all the, again, the financial analysts, the pundits, the gurus, they all come with their predictions for the following year. And what happens is, it's very interesting how many of them are not accurate. So I thought this was interesting, looking back to the forecast for 2021. As you know, the theme was the inflation. So the big theme has been inflation and interest rates. And this was the projection or predictions for the Q4, quarter over quarter. And that was with 2021. So first of all, the private forecast, the smart money, as they say. So basically, they had the PCE, the core PCE, which is the personal consumption expenditure, which actually Fed looks at for the inflation gauge. This is in May, almost 5 months from beginning of the year. So they had 5 months, and this is the median projection they had. They said it will be 2.3%, and the top of the range will be 3.2, and there's 0.5% the likely it will be above 4%. And guess what it was? It was 4.5%. Even FOMC, which I have a lot of problems actually, and I mentioned in our last class, is they're the ones who have the most powerful force in the globe when it comes to monetary policies. So they had their core PC at 2.2, and the top of the range was 2.5. And of course, it came 4.5. And with the markets and looking at the things, looking at the CPI, this was in March. And by the way, this was September for March, and then March for the CPI, the projection was 2.7 and we came at 6.7. So all these projections and forecasts for inflation, you can just put it aside. Now, the other thing is we usually have all the Wall Street, again, analysts, they come with their projections, and this year was no exception. For your information, S&P 500 finished at 47.66 on December 31st. And these are some of the samples from Credit Suisse, which thinking we might go up roughly about 10, 11%, to Morgan Stanley, which thinks we're going to go down. And there were the 45 Wall Street analysts, the median prediction was the 49.10 from 47.66. A 20% gap between the highest and lowest is one of the largest we've had in a long time. So basically what happened last year in 2021, S&P outperformed the analyst median prediction by 20%. So again, I don't pay any attention to this. The idea is, again, what we are talking now is you really want to be master of your own destiny and do your own research and investigation. I want to add one more thing. This is from November 15, and Morgan Stanley says steer clear of US stock and bonds in 2022. But this was an interesting thing, is that the muted market expectation come amid a wider debate at the bank over the outlook for US monetary policy. Morgan Stanley economists predict the Federal Reserve won't raise interest rates until 2023. And this was November 15. Now you can understand why when they, like, let's say the Fed minutes came out, there was a big, shock. And that's one of the reasons when they have these expectations, everything really makes them to rattle. So, and of course, the Chairman Powell, he had his job interview, I would say, yesterday at the Senate hearing, and he basically tried to calm the markets down. He mentioned about inflation. It would be very data dependent. So he keeping the door open to when they will decide to do it, how much they're going to do it. And then obviously the balance sheet, that's a big thing when we have a $9 trillion bonds that they've been purchasing. Now they have to unload gradually. There's not, at least there won't be that liquidity. That's a concern for the market. So having said that, I just wanted to make sure that we understand what forces are working out there. So as I said, we want to be independent. As I've shared this before, we are in the second year of the presidential cycle. And as you can see, the midterms are the most neutral of all the other 3 years are usually very positive. The pre-election is very positive, but the midterms are the ones that you have to be cautious. And my theme for you will be for the rest of this. This is going to be a market, I believe, that the easy money has already been made. And this is the time you have to be really doing your own homework, do some research, and be prepared for volatile markets. We could have some really big ups and a few big downs. So the question will be, you want to be prepared for that and go with the flow. So I'm going to look back a little bit as far as where the stock market has been from S&P, and you can see we almost had a parabolic move since when the pandemic started, from the bottom of our March 2020. And I want to compare it with the commodities, and you can see I do remember this was a wonderful ride with the commodities, especially with the gold. And then before that, crude oil and silver and natural gas and copper. And basically we topped, and then we had bottom And we really just gone back where we were in 2011. And while the market has completely, just from beginning of 2009, except a couple of blips, it has just continued. So that's one thing about thinking about these the CRB raw industrial, the commodity prices. Where do we stand? Is this a continuation? And are we going to go with the parity with the stock market? Will that stock market will come down and we catch up? And you have to remember, you usually go for a 12-year cycle with the commodity. So the question is this going to continue for the decade of 2020s? And we can build our scenario based on that. If that's the case, how would that affect the dollar? And what happens to the inflation? And would that create more of the natural resource economies, especially in emerging markets, to make them outperform, for instance, developed markets, especially United States? So we keep that in mind. Also, I want to just give you a little, again, history of what we did last year in the fixed income side of things, in the bond indexes, from the broad market, which is like, let's say, core bonds. How did they perform? And that the core bond, they invest in I would call it's like a buffet of bonds. They do treasuries, they do mortgage-backed securities, they do investment grade bonds, and they actually were negative. So it was a very challenging year for all the bond markets. So basically what we should look forward this year, especially it's given that interest rates looks like it's gonna go up. The question is it gonna go up 3 times? Is it gonna go up maybe even 4 times according to Goldman Sachs? And that's the question. So we will review that. And the last thing I would say here is these were the performance of, we want to look at the large caps, small caps. How did they perform? And you can see for 2021, S&P 500 was up almost 29%. S&P 400 was almost 25%, but the small cap, the Russell, was less than 15%. On top of that, when you look at emerging markets, they were actually down 2.5%. Japan was almost 14 and Europe was about 26. On the fixed side of things, as you can see, again, the high yield was really the only bright sign, and it again related to the corporate. So it was up 5.4%, but everything else, including the emerging market bonds, mortgages, treasuries, and investment grade bonds, they were all in negative. So here will be the key factors, I believe, for 2022. And that's what we look at, the big picture and what is going to guide our investment decisions in 2022. There are more we could speak about, but I chose these 5. I think they are going to be guiding lights. Of course, the Federal Reserve and all the central banks around the world. It's not just Fed, but of course, Fed being the most followed. And that's the biggest economy. So that plays a role. And so every word coming out of the chairman and the committee members and the presidents of the different banks, it means something, and the world is watching. The COVID-19 variants, as we were witnessing it, what happened right after Thanksgiving, end of November, it looks like, it's fact of life. It's affecting a lot of economies. And the question, the good news is, in one hand, is all about it's not as deadly anymore. There are solutions, but it is a fact of life. And now, for instance, in Europe, from UK to Portugal and Spain, I believe Spain, and they want to make that pandemic change to endemic and make sure that it is treated like a flu, or even maybe influenza, but flu. So that's one direction positive, so that people are accepting it. But doesn't mean that the health costs and other things, when you go to the hospital, hospitals are full. So that how was that's still going to affect us. The third scenario will be, or the affecting the key factor will be the bond yields and interest rates. So the bond yields, we have to think about that, uh, looking at the yield curve, and then I look at what are some of the opportunities as far as the bonds. Is it in the long end of, do we even look at the duration of the bonds? Or should we now, about time, look at some sovereign bonds, some international emerging market bonds, which they have been underperforming? So these are the questions that we have to answer. And that's all, again, depends on how fast this tapering is going to happen, how fast this unloading of the balance sheet. As I mentioned, it looks like Chairman Powell is backed up and he's like saying, we will do whatever it's needed, but again, it will all depend on the data. So we shall see. The fourth thing is earnings, and we will review. We've had some of the most fantastic earning growth, like last year. It was excellent. The whole decade of 2010s has been an amazing earning growth. So would that continue? And of course, that's the engine of the corporations, and that's what the valuation of stocks come. So how would that be affected? The last but not least in everybody's mind is inflation. We were told that was transitory, not to worry, and then you can see we're still in that debacle. We will review that. I would add, we've had the most accommodating political and fiscal policies, and they are coming to an end. So we've had the monetary, fiscal, and then also political. So these are going to be the challenges for this year. So that the politics of it, and of course there's a midterm election. So that's another thing that we have to be concerned with. So these are the questions we have to answer, but I will emphasize on these five. The first two we've already addressed, so I would not go into details on those. So I'll start with the bonds and where do we stand? So first of all, I want to share this long-term monthly yield of 10-year notes. So it's a 10-year yield. And we can see, if you recall early 1980s, which I remember very well, going to school and the loans that I had, that was the height of the interest rates. And then if we had the inflation and the Chairman Volcker, Paul Volcker comes and, some of people respect him so much for what he did, but this is where we were. And this is where we have come to. And that was the base, I believe, August of 2020. So this is a long-term trend. And I've had also my support lines, and it looks like that 2%, still mentioned that 2% on 10-year notes, the yield is acceptable to the markets. That's when they get worried, and when we cross, and you can see that the long-term trend line and this horizontal resistance, they cross, and I think that's where a little nervousness come in. And that's when we will talk about growth versus value. What happens to the equities based on that? But this is where we are. We are breaking that long-term monthly trend, which goes back to 1990s. And basically, we are about to go to the 2%. Looking at, I just thought it would be good to know how the bond markets, the aggregate bonds, the ETFs have performed during past 17, 18 years. And you see like the past 3 years, 4 years, I mean, they have not performed well at all. Now, it is good for this asset allocation. Some people that we don't even know that 40-60 asset allocation is valid anymore with the returns like this. I mean, 2009, 2020, they did okay, but last year we were down. Now, would bonds still play a role, at least the domestic bonds? And then we look at the LQD, which is the investment grade. Now, that was a negative. It has done a little better, but we've had like 4 years. This is before even, we had the financial, crisis in the 2008, and that's what their performance was. And we look at the Vanguard's total bond funds. So these have been the performances. So I want to share that with you to see where we have been. As far as the earnings now, basically, I will get back to the bonds because we want to look at some alternative. It looks like that the increasing rates, maybe that's not the place to be, even including mortgage-backed securities. As I mentioned, would the sovereign bonds, maybe, as I mentioned, emerging market bonds, would they offer some better opportunities, not just this year, but for the years to come, as well as maybe a little bit in the high yield bond, as long as there's a healthy bonds and corporations. But that's going to be still challenging. Again, there's a lot of unknowns. So let's talk about the earnings, and let's say where we have been as far as the valuation. And I think the theme for this year would be valuation, valuation, valuation. Now, we've had the momentum investing has been wonderful. And, especially if you had like a mega caps and with all the money coming in, it has been great. But as far as we looking at going forward, are we done with that cycle with increasing interest rates and inflation, especially interest rates? Would that affect the growth companies, which we will talk about in the value versus growth? So let's talk about valuation point of view. Today, the current Shiller PE ratio, which is basically it's inflation adjusted earnings, and it looks at the 10-year averaging and it makes it cyclically adjusted because of inflation. We are at 39.54. The mean has been 16.9, and the minimum was actually 4.78 in December of 1920, which is right here. And the maximum was 44.19, right around the internet bubble at December of 1999. So from valuation point of view, as you can see, this is pretty lofty. Now, of course, we had very accommodating, as I mentioned, fiscal and monetary policies, and with interest rates being so low, money had no place to go but these growth companies. And obviously that's what it was about the earning. So the price really was not a factor. That we're willing to pay as much price because it was worth it. And but the question is, will it happen going forwards? How far can we go? And every time we've had these peaks, like for instance, in 1929, we peaked at 30. We've had a huge adjustments, and the same thing you can see. Usually what happens, or we go completely the other way. And what happens is, one of the things we've discussed in the past, and I've heard it from many people, that, in 1918, we had the Spanish flu, and here we are in 2020, we have the pandemics, and the 1920s, it was the roaring 20s, and basically the age of really innovation, in a way, industrialization. And here we have the age of innovation. So it is going to be a roaring 20s again in 2020s. My argument for that would be, and I kind of disagree with that, is precisely this. I mean, we had no choice, but I mean, we had the World War I ending. There was a lot of depressed stocks and equities, and there was a lot of other things, as far as, we had the 1913, the Fed comes in, we had the banking, reinvention of banking system. So this happened. Well, we already are here, and how far can we go to justify this growth? So that's where I have problems with from the PE point of view. As far as the earning growths, this is from 2010 to 2020. That was the best decade as far as earnings year over year. We had averaged 8% earning growth. the average is a little less than 2% for all the decades. So would the 2020s be the similar thing? Or after every big one, and see when it's like really stretched, we usually have some adjustments. We've had it in 1990s, we've had it in 1920s, and we also, what happens when it's gradual, it gets a little less. And but what about the earning growth to justify the valuation for this high PE ratio companies, the mega caps, and some of these big technology companies? Also, as far as the growth and earnings, or S&P, last year, 2021, was fantastic, and it was almost 50% growth year over year, albeit it was, 2020 becoming from a really from nothingness, so that makes sense. But we are going back to some more normal, going to get back to 10%. Now, again, we have to look at, is the valuation be justified? So that's another thing we have to look at. The last but not least, I want to share this with you, and some of you are familiar. We talk about the squeeze, and we talk about the linear regression channel, and I want to look at the monthly of the QQQ, which is the exchange traded fund for the NASDAQ 100. And what we see from the momentum point of view, we already had in 1919, we came, the squeeze fired, and you can see the momentum. We've had this beautiful momentum going up. It's justified, we see this. But look at, for the last 3 or 4 months, we're really tired. And this is telling us, it looks like, at least for now, is like there is, again, some concern, and whether this can go back and go to big momentum, that's question mark. Now, when we had this squeeze, and of course this squeeze, you can see how the bars were nice and orderly. We've had this big bar. So from looking at from the charts point of view, that also brings us to question, at least from the NASDAQ 100, which obviously is very much technology oriented, and whether we are tired. So with that in mind, I mentioned I will not do any forecasting, but I just want to say this is one of the most reliable things. People have done this. This is what's out there. The inflation forecast, the idea is the chance of going over 5% by end of the year is about 7%. The median, when we look at it, is about, most likely will be over 3%, 3 to 4 is 35%, with a mean of 3.2%, which is actually higher than what the Fed is hoping for. So the question you have to ask about inflation. So this is what the numbers are out there. I give you from the street point of view, as a just from a business person's point of view. I'm looking at this, how this inflation came about. It was, number one, with a lot of stimulus checks, people being at home, they cannot go out. So for the first time in a long time, I believe from 1970s or so, we went from the inflation from the service sector to the goods sector, to the materials. I'm at home, check is coming, well, let me shop online, let me buy things. So consequently, because of that buying, there was more need for the raw material, more need for, again, for more production. And so that was one of the biggest factors. And again, with the low interest rates and accommodating, and again, financially accommodating, we moved from service to goods. And that was a big factor. The question is now, with the employment being down, and would people going back to work, for instance, or employment? And one of the reasons that a lot of people are not having gone back, because they retired and they're not willing to go back. So that's what that comes with the participation numbers that we've spoken, which is lower than the 2019. So with the 3.9 so-called percentage unemployment, now there is, there's almost lots of job availability and the growth. the question we have to ask is, we are going to continue with this, not only the good side of things, but what about the service side of inflation? And when I talk about service side inflation, we're looking at the housing, which has gone, I mean, it's been unbelievable, which has been a big part of, with the CPI. And then we have to look at the medical care. And that's, again, the COVID and all that has affected. So we have the medical care or health care, we have housing, and then we have education. So all of those also gonna have a factor in affecting the inflation. So would this be transitory? I would say it's still, we don't know. I mean, it could get less, but we still have problems that they have not been resolved. And what's going to happen? Nothing just goes away overnight, even with the supply chain issues. And the other thing you have to also remember, if I'm expecting inflation, let's say a year from now, and I think the prices are going to go up, what's going to happen? I talk about maybe I need some household goods, durable goods, and I want a washing machine, I want a refrigerator, and I would say, well, maybe I should buy it today before the prices go up. So here we go with the demand side. And again, we have supply chain issue. I'm going to buy this because I think the prices will be higher in the future. So it kind of becomes a self-fulfilling prophecy in that sense. So I'm looking at from the street person, I'm looking at how this inflation is going to work itself out. Again, the talk has been more of a, maybe that was the supply chain issues, but other than that, there's a lot more going into it. On top of that, I think the emerging markets also have been contributing to this. So basically, I don't think we are out of woods. I don't believe there's going to be the 2% suggestion that the Fed has done. I would believe, the numbers came today, for instance, for inflation, and that was the highest, I believe, in 40 years since 1982, year over year. And basically month over month was within the expectation of 0.5% versus 0.4. But what that means is the inflation still is here with us, and I won't be surprised we'll have a 4% inflation, although it will, second half probably will start taking care of itself. And that's what Fed is trying to do with the higher interest rates. We shall see. So I'm just saying it's not that simple. I'm throwing you these numbers, but it's all guessing game. All right. So we talked about, kept talking about valuation. So let's look at value versus growth. So let me just present to you how, as a whole, this is Vanguard ETF, the value oriented investments, and you can see it's been up and down. They're not, except 2013. Last year was pretty good, especially after the vaccination, the election. We got some attention in the value, but 2020 it was negative, of course, with a lot of shutdown of the economy. So there's not many technology investments were here. So the money went actually to technology. So just keep this in mind. We've been down, up, and then this is our growth. And the whole 3 years, obviously, I mean, look at the whole decade, the growth has been beating the value. And I just showed you what a wonderful 2010 to 2020 earning growths were there. So I look at the ratio of the value to growth, and this is on a weekly basis. You can see this is what happened in 2020. And then after the vaccination news, you see for 8 months or so that the value started beating the growth. And then again, we had some more news, and that's the variant comes back, then it goes away. And then what is happening though, as far as the valuation now, right around November, we started that our value, Vanguard's value is beating the growth. The question is this a turnaround? And we will be continue. And in my opinion, actually, I think for next few years, I think I would be, of course, I'm a value investor to begin with. So that's by default, by the way, but here I am. But I believe this is about time to research more on the value side of things. And the market is telling us moving away from the momentum side. So we shall see. But this is how right now the momentum has changed for the last month and a half or so. And this is the chart of the weekly. You can see we are nicely above the 20 weeks and the 50 weeks moving average. This is as far as the value ETF, but the growth, you can see there was consolidation, and then we just broke below the 20, trying to come back. So that's a food for thought. Now that we presented the value side of things, would be which part of market cap should we be in? Small caps, medium cap, or large cap? So again, the Russell 3000 is the total members, and so it's the total package. So these are the returns we've had besides 2000 and 2001 and 2002. We hardly had any year down more than once. I mean, so 2008, 2011, 2015, and 2018, but it looks like every 3 years or so we need a little bit of correction in the markets. As far as the large cap, the top 1,000, the value, again, 2020 was pretty nothing, no movements, but then we had some nice, but still we lagged the growth. And when we come to mid cap, the value again basically lagged the growth now, but you can see the movement from the growth for 2021 going to the value is happening. So this could be the startup. So and then when we go to small caps, the value movement is happening from from small cap growth, as you can see, to small cap value. So the conclusion will be maybe looking at actually totality of some, it looks like the small cap value has gotten its momentum. It's continuing, but even large cap values could be attractive. And that's where we should look at. All right, so I hope that was helpful, and that was looking at the big picture. So let me give you some of my themes. So we will have maybe, I think, about 8 themes that I have for this year, and I would say beyond. So one of them things, again, is the communication. I mean, this is the world that has gotten much smaller, and we've moved from 3G to 4G, and now we are in 5G. So and we're going to go beyond that. So basically, we are looking at, I mean, globally, where the percentage of population that they actually have internet coverage because of the infrastructure. So as you can see in Africa and basically this is the Central Asia, and so there is some needs for that. So here comes, we got a 5G, but the satellite is becoming an interesting issue. So would satellite internet change the world? And that will come up with the 5G, including actually it's going to go beyond that, go to 6G, and we go to Web 3.0. And when we look at the population which is connected to internet, we see obviously the globally 51% are connected, but 43% they cannot use it. They don't, because of whatever it is. And then you have the coverage gap, which that means there isn't any availability. So basically there is this big gap, 49% of the world. And of course, North America and Europe being the biggest users of internet. But when you go to Middle East, South Asia, you go sub-Saharan Africa, there's a lot of needs. So what can we do? So there's some ideas, again, some themes. One of them would be exploring a lot of these themes that I come with. I'd like to offer you some ETFs, and that's one of them would be 5G. But these are some of the companies who are going to be the benefactor of this, again, revolution and evolution, basically moving. And I'm not going to read those. You can have access to these. So these are the obviously technology companies that will be really moving forward as far as the 5G goes. Then, AI, artificial intelligence, is here, but we want to be more specific to the data center part of things. And the companies are AMD, goes Broadcom and Ciena, and again, Micron Technology, NVIDIA Techs, and yeah. So the next theme will be the life sciences and the health, specifically on the healthcare and the life sciences. And these are some of the ideas that I have. Now, these are ideas, they're not recommendations. I'm looking at the themes. So these are the things that you can actually look at the stocks and do your own investigation based on those. So basically, you shouldn't go buy, in this case, like 10 of them. Just find the best valuation and best potential, the growth potential. And as I mentioned, this is a good year to have value with the reasonable growth. So basically, you want to have growth. Definitely every company, you want to have that growth. I will have low debt, and I will have more of, again, the valuation. One of the problems I see in the decade of 2010 and on with the quantitative easing, it was like really giving an addict, giving the drugs, and now they want to put you into rehab and take it away, and that's going to be the tough thing. And that's what I think the markets had the reaction. So it's very difficult when for 11 years you've been getting injections every day, every year, and all of a sudden they say, you know what, we're going to slow down on those injection, and eventually we're going to stop it. So that's the challenge we have, and I think it's going forward. Innovation, so that's also obviously it's very important. That's what pandemic did for us. It really pushed forward maybe 4 or 5 years of innovations and technology, from AI to robotics and a lot of things, and the medical discoveries. So these are some of the well-known companies. So, and obviously the self-driving companies, and there's the electric vehicles, and so the drive might be an interesting ETF to play with. The next thing is, with the competition and everything, is how about companies that they need to be breaking up and they make more profits that way. Right now, maybe a portion of them is really stale, and it would be a good idea when these large companies, if they can divide their divisions, they might be profitable on both ends. So these are some other ideas, from Facebook to CBS and Boeing to GE, for instance, Johnson and Johnson, and even Exxon. So that, 3M, and these are some other ideas for breaking up. Now, the rest of my present, you will see there's a lot of connections. And I think this is, again, going forwards, and it happened starting in Davos, and it's about the ESG, which is environment and socially responsible and governance. And basically, that's a sustainable impact investing, we call. So you will see going forward, I think this is going to be a huge demand globally on investments. And you combine that with the cryptocurrency. We look at alternative energies, clean energy, again, with the environment, and basically emerging markets. All of those, they have a lot of commonality. So the sustainable impact investing is here to stay with us, whether it's political or not. This is what's happening. The carbon footprints, a lot of companies are demanding, and a lot of ETFs, a lot of investing is done based on that. There's a lot of demand for the institutional investors to invest. So these are some ideas, some of these companies that they fit that profile. And basically, it's a list of some of those companies in a sustainable, area. And then I go even further, as I mentioned, that theme continues globally. And I want to offer you some ETFs. Again, these are not just like a recommendation, just go buy all of them. They have an interesting story. Some of them are very small, but they are working on specific niche that they feel it definitely has a foundation to grow. So basically, there have been some research done with telomere research, and it's in the climate to become the default ethical investment choice. So that's what the ESG comes into the picture. And we're talking about COP2, we're talking about climate, COP26, even the pensions, new pension rules are happening. So I want to pay attention to this if you haven't already. And even the commodity investors are looking at the ESG compliant portfolios, looking at how the food, the way it's made, and definitely it's you can see pooling like palm oil. We cannot, just a violation of ESG. So how would that get affected? And some of the companies who are compliant and in this situation. Also, the crypto, that's another common theme, which we will discuss a little later. That has been a big issue, obviously, with the energy side of things. So that ESG becomes a common theme. So here are some ideas for you that they're, again, friendly. As I mentioned, there's some small, but I like to give you the idea so you can do a little more investigation on your own. You can see the carbon footprints, and then we have the ESG friendly equal weight of the S&P 500. Of course, water is a huge issue as far as people don't realize how big of a commodity water is. I've been investing in PHO for the last 15, 14 years. So it's just something to consider. And then the green bond. I mean, that's, again, just look at it. It's sometimes the performance is not there, so you don't have to do that. So, but these are just some ideas. Another interesting thing that comes from the Cathy Wood's organization, the ARC, is it's interesting that she's using to track 100 equally weighted index of global economies who had the highest score on the transparency side of things. So a food for thought, again, ESG friendly, the CTRU. So with that in mind, we're doing the transition. We want to go from the socially responsible to the governance. Gonna go to the China story, which has been a big story, especially in the last 2 years. And from the political side of things to health side of things, from cultural side of things. So it's very important to understand it. And then you will see how China becomes a central figure in a lot of things. And that takes our story to the emerging markets, and emerging markets, we even go to cryptocurrencies, to commodities. So I think the next few slides are very much interconnected. So First of all, when we talk about China's story, I want to mention about something that's happening. And it's been, again, we talk about ESG. The question is the income inequality in emerging and developed markets. And when you think of that, usually we think of like maybe African and very maybe frontier markets or developing countries. And you can see South Africa is on top of this. But believe it or not, United States is at like, I believe it's about 41%. UK is there, and US is at 41. And China is about 39. So the inequality exists in developed markets and underdeveloped markets. And I think because of the um, uh, uh, populist issues, it has become an interesting issue from right wing to all the way to very much left wing around the globe. So it's something you want to respect, and that's one of the central issues, I think, in China. And we'll discuss why China, what happened last year, and I hope that will explain. It's like, for instance, again, with this catching things, addressing inequality. I mean, looking at from the Eastern European countries, from Poland, Hungary, and Romania, and Brazil, which is one of the right-leaning, to looking at the left-leaning in Latin America, from Mexico to Argentina to Brazil to Chile to Peru. And then we come to Modi in India and Duterte and Khan in Pakistan and Sri Lanka. So all of these have been an interesting theme. So I bring that, and this is what happened last year. And I think um, that China's from the Central Party, and they came to that realization that they want to deliver economic benefit to the masses. And because of that, seeing that the disproportionate um, uh, wealth in elite, and there was this catchphrase was like 1%ers, is they decided, they said, well, the government of China, basically, that's what they've been based on. Their legitimacy was about masses. So that's why I think this might explain, that the common prosperity, when they started the scrutiny of, the entrepreneurs, and they started cracking down on big technology and education and gaming and real estate. And that's what happened in 2021. And I don't believe that's going to go away. And when it comes to China, that's something that they decided, and that was the reason. So on top of that, there's the China story goes on as far as the retail sales have been coming back. The question is, and you can see we've gone, when we look at the month over month, obviously it has done better. The GDP, on the other hand, the whole goal has been we want to leave it at about 5%, but it's 5.5%. So that's what the push, but it's going to be a little difficult. There's a lot of challenges in China at this moment. And also, you have to also remember that culturally, we have to understand the Chinese environment, and to talk about vaccination and all the other things and lockdowns. We have in February, we have the Olympics in China. Now, that could be positive. I think that's something, but that will be the control. So, but people in China have become more risk averse. And at the end of the day, what happened last year in China, I believe, although we have some fundamental problems, but that also has presented a lot of great opportunities. And that's what I will look at, opportunities in China, which I will discuss further in our emerging markets. But look at the internet valuation of the companies in China versus USA. So right off bat, that's one of the issues. There's a couple of companies we've talked about, and they were obviously big losers last year. But I will look into these companies. I would explore some of the ideas. The K-web is really Chinese dedicated, but EMQQQ is the emerging market. So that's something, some ideas. Also, I want to show you, this is what China has done. And of course, we had the roaring 2005 and 6 and 7, but it has been a kind of a roller coaster in a way. So, but after a big drop, I think this will be a good place to start at least doing some research and find some values, as I believe there are. So that's as far as China. And now we can bring that and tie everything to the emerging markets. So first of all, with the emerging markets, now the rising inflation creates challenges and also opportunities. We have to also look at their currencies and see how they get affected. Now, the interesting thing is with the inflation and the places to be, as far as emerging countries, it will help, the inflation will help countries like Poland, Nigeria, Mexico, and Kenya because of what is happening with the growth outlook and the asset qualities. On the other hand, in Vietnam, which has been one of my favorite places in the last 5-6 years I've been investing, Vietnam, Iceland, Hungary, and Peru, they're gonna be struggling. And one of the main reasons, obviously, like in Vietnam, we look at, they've had problems with the dong, which is their currency. Now, how would they behave, and that devaluation of their currencies? So these are the things, and we look at the debts, for instance. So that's one thing we want to look at. The second thing is, now I'm looking at the opportunities. The opportunities are that in the Western world, we look at credit completely different than the developing countries. Majority of countries in, communities, economies in developing countries, they buy things cash. You don't have mortgages. You don't buy a car on a loan. You go pay cash. And basically that sentiment is gradually changing, obviously, with the entrance of credit cards. So we want to look at the comparison of the developed countries from Canada to United States all the way to France, and this is as of 2017, when you compare it to emerging markets such as Pakistan and all the way to United Arab Emirates, but you can see it is very low usage of credit, but with, again, the internet connection, access to all kinds of communications, things are changing. The goods are changing. So what happens, here it comes, and I think this is a favorite of like students, now buy now, pay later revolution. So this allows the emerging market consumer to, without having that really credit card, they actually start using credit to purchase things. And that could be one of the reasons maybe inflation is not that transitory. So I'm looking at, so that's creates an interesting opportunity in emerging world. By the way, this is, I just thought to share these with you. In the United States, obviously, like a firm was a great stock, and then obviously fizzled out, but it was a great idea. So these are just some of the best apps in, and just for your information, some of the companies and why the growth drivers for this BNPL is, again, the e-commerce digital payment option, which we will discuss this more when we talk about cryptocurrencies, rising income levels, the consumer segment of the emerging countries, and the low credit penetration. So that's a positive. Here about if you wanted, and if you live in one of those countries, if you have access to international money, this is some of the ideas there. But the whole idea is the opportunities that can actually present themselves to other segments. So when you have this, then you have access to maybe purchase other goods that could be European or American companies. On top of that is the shopping. That's why I want to tie everything together. The 5 baby Amazons. that we feel that could prosper in 2022. And basically, the biggest one being Alibaba and Jumia and CLTD and the Argentinian company Mercado Libre, and then Coupang, and basically all these companies. Some of them are still overseas. That's another area that could be attractive, and you can actually invest in those in emerging countries because, again, the consumer is there. The other part is the food delivery, and that we've had the DoorDashes of the world and the Grab and Grab, and so that's, again, they're coming of their age. And then remember that the younger demographics creates even more growth. And this is just the revenue growth forecast for 2022. Some of the companies, the majority of them are listed in the United States, and you can see the growth for, let's say, Baba and Melly, and then Allegro, which is a big online shopping in Luxembourg, for instance, or Obuka in Indonesia. So these are the things that you have a theme that might be worthwhile looking at. Now, in 2020, they did fantastically, 53% down, but last year they were down 15%, and they are underperforming what is happening in the the emerging markets. So emerging markets have good valuation, and these have even better valuation. So that's another food for thought. Now, other thing about, again, I'm trying to come up with, I'm tying in the socially responsible things and the theme with the emerging markets. And these are three interesting ideas that, again, they're small ETFs. You don't have to do it now, but I just want to give you ideas. This is something, if you want to look at it long term. There's Freedom 100. These are the countries that they have democracy in emerging markets. Cambria has the emerging shareholders, which is, again, that goes to the governance, and Invesco has the PX Edge. So those are some other ideas. Another interesting theme in emerging markets, we talked about value, we talked about a small company. Imagine if we combine, this is international small cap value, and this is AVDV, which could be interesting. It's a $1.32 billion under assets. And so that's another thought. Although I'm talking about emerging markets, I just want to show you what the developed markets internationally have done. And again, they've been up last 3 years, but with not much. So if you compare this, for instance, with the US, the growth, the VUG, for instance, the Vanguard growth, they're not comparable. So is it time, perhaps, and again, I'm not talking about just this year, look at overseas, specifically looking at some of the emerging markets. So they were down last year, VWO. Now, when they go down big. When they go up, where they can move up. So basically, had a losing year last year. We can be selective, for instance. Now, VW is the Vanguard, but the most famous a lot of people follow is the EEM. As a matter of fact, for instance, last week there was a big call options buying on EEM worth $5 million. So these are things maybe you can investigate more, have a little portion of your investments, especially if it's more of a long-term, gradually moving to these things. So the other ideas would be like South Korea, for instance. South Korea was down last year. There are some very much respectable companies in South Korea, from LG to Samsung, we got Pohang. And so these are the things that, it's a food for thought to evaluate what's going on. I mean, India has been a big winner. It has been consistently go up. These on the other hand, these countries are offering some opportunities. Brazil, 2 years in a row, of course, they have high interest rates. They're combating the inflation. Now, the question is, are there some companies, even looking at like Petrobras, which has energy? Of course, there's been some corruption and all that, but with Petrobras and energy sector, but there are so many other companies, including in banking in the Brazil. Is it time? Of course, you can see when it goes down, it can continue going down. But then when they rebound, I mean, there's no stopping. So basically, that's a food for thought. They've lost 3 out of last 4 years in Brazil. So going from the equities, let's talk about some emerging market bonds, the sovereign bonds. So as of last year, we had lower issuance on the sovereign bonds at $172 billion, which was 15% below 2020. And especially the last month of the year was only 0.4 billion. So the biggest issuer, the biggest one, the sovereign bond, was from Chile for 15.5 billion, then Indonesia, Saudi Arabia, Turkey, and Peru. So here's some of those. So would sovereign bond funds, maybe emerging market bonds, or even some frontier bonds from Kuwait to Egypt, and looking at some of the opportunities, would they pay higher yields and be attractive? So one of the funds is EMB. We also have PCY if you were interested, but I just want to show you. So they have, when you compare this, granted, I mean, when they go down, they have some double-digit downs, but when you look at the US bonds, you know, they basically, it's after 10 years, it's negate itself, the whole growth. So there are some, could be some opportunities, just if you want to look at that as a part of your portfolio. Next, we want to look at, again, coming back from emerging markets, the ESG, the China story, the well, talking about crypto. Crypto was the big thing last year. Everyone I talk to, if you're in the office or you're shopping, if you're talking about 14-year-old my son's friends, they talk about NFTs, the DeFi, and so that was a huge thing. And obviously, we've had a major correction since November, and actually it was August, and then November predictions came, and so we've been going down. But some of these cryptos, they did, you know, we had 8,854% from, you know, the Matic all the way to Ethereum, which was up 1,212%. So in reality, you can see Polygon, the Matic, was 8,854%, Terra 8,870, and Dogecoin, and you know, and so on. So you can see Polkadot 80%, which is unbelievable. So there were a lot of people who made money, and there's lots of people who are suffering right now. So what are our thoughts? By the way, these are just explanation of some of these tokens. You know, how do they work? And some of them, they have the validity, if they don't have validity. So from Matic to Luna being the Terra blockchain, and so with the competing with Ethereum. So so when we go to emerging markets, there's definitely more acceptance, and it has that value, whether it has to be, you know, going against the big powers or whatever the mentality is, the cultural thing. The question I will have is, again, it's going to be emerging world versus the developed countries, and what's going to happen when it comes to regulations and understanding. So, but when we talk about everything is directed, when we think about definancing and the infrastructure in emerging markets, there's a lot of movements are happening there. And even the central bank digital currencies are becoming disruptive, and starts from those places. And you think about like El Salvador, for instance. But I will give you a caution. And if there was anything that happened in last few months, we hit 40,000. We were almost at 70,000. We were at 70,000, came down to 80. And I've mentioned it before, at 70,000, the talk was it's going to go to 100 by December. So here we are. And even though Goldman Sachs has predicted it could go to 104,000 by end of this year, funny things happen. And whether if there is a correction in the markets, whether the stimulus money has stopped, that was part of the money going to this, whether it was the halving, which happened in May of 2020, and it was the supply and demand. And I think we did a class on that, in May of 2020, when we said usually the market goes up for the next 18 to 24 months, and after that, it's kind of stalls. So whether those are the questions you have to ask, so the pros and cons of the cryptocurrencies. One caution, the one caution is this, and again, I've lived through the internet bubble and other things. So now, Crypto.com paid 700 million to rename the Staples Center to Crypto.com Arena. Back in 2002, New England Patriots called their home CMGI Field, and Baltimore M&T Bank Stadium was named PSI Net Stadium. And both those companies, those stadiums, those companies went bust right after the .com. So it's just a food for thought. You want to just be very careful and look for quality. There's one company, it's an ETF with the cryptos, it's BITS, and which is BITS, and it's actively managed fund. It's a very small fund. It's only 8.65, but it offers an interesting combination of different things. So just a food for thought to watch. Coming from crypto and inflation, whether that is inflation protection or not, we go to the a real thing, and that's by the way, some people called crypto like a Ponzi scheme. Somebody buys from another. Although I do definitely believe in finance and the blockchain technology, but when things move up so fast and so quickly, and when it becomes very popular, I always have my emergency lights on to just be a little cautious. So let's think about what's happening with gold. So gold is supposed to be the inflation play, and in the last year it really didn't perform. And the question was, what's going on? Well, the stock market became the inflation protection, and crypto was trying to compete. So what's going to happen with the rising interest rates? Is that good for so is this going to be inflation play, rising interest rate, which is not good for gold? But at the end of the day, one thing is for sure, gold is a real physical thing. So at the times of the unknowns, usually gold becomes the safe haven, although it hasn't performed as well in, for instance, last year. What I want to look at it, this is all analog. So what we're looking at, if we transpose what happened from the low of 1999 to 2015 for 16 years. And if we fast forward it and we go from 2012 low, remember we had a big jump in 2011, and then we came back. So if we transpose the same 16 years, this is how it would have looked. So basically we are here in that cycle, and this is where we hit 2011, which is taking up to 8,000. So, I've heard gold 5,000 so many times, but this is just from if the cycle and history repeats itself. This is one food for thought. And of course, with the real yields and real interest rates, that also can become, again, we look at the inflation and interest rates, that's usually gold performs better when we have that gap. From the charts point of view, on the other hand, I want to look at gold on a monthly basis and going back to that 2012 uh, area and looking at the squeeze. So where we are on a monthly, we are on the one standard deviation and LRC, the negative. So from chart point of view, it looks like we are basing on that. From the squeeze point of view, it looks like that the time hasn't come yet to completely go in. You can see we still, so we still red on the downside. It would be nice to have something like this, and especially when we squeeze here. But it would be good if the bars changed color. So again, this is on a monthly. If we change to yellow, although the C wave and A wave are positive, so those are good on a monthly basis, that gives me more comfort to be in the gold play. Now, this is what GLD did last year. It was down 4%, but 2020 and 2019, they were pretty good years. So 2011, we peaked right in the middle of the year. Silver did in April, and gold, I believe, was July. But you can see how nicely they had done. So it had a correction toward the end of the year. But gold definitely is in play. And on top of that, what I want to do, if we want to look for the valuation, I want to see what is the gold miners relative to gold. And you can see the lowest we've been, it was at 0.33. And we are at like 0.49, and the average is 1.07. So if you're bullish about gold, it looks like there are more opportunities in the actually the miners. Now with the mining, it goes back to that ESG. It goes back to the shutdowns and especially what is happening in Chile and what is Vale is trying to buy the mining company, and there's a lot of noise going on there. So basically, it is GDX will be something that I would definitely look into. You can see, we were down last year 11, but we had a nice couple of good years. Of course, after the 2011 top, it just it was more of a debacle with the closing down the mines and then the expenses. The second thing is silver, and I'm also an advocate of silver, especially from this reason, which is separate than gold, this industrial application in solar panels, electronics, batteries, and biocides. So that's 51%. And if the economy starts getting, especially we're talking about emerging markets, and of course we have the alternative energy and solar, and then once we get this supply chain, and that's a double win, because if gold goes up, regardless, usually silver just follows gold. So that's a win from the precious metal side of things. And if the economy expands, then the silver could do well. So I would definitely watch silver. Again, 2020 was wonderful, one of the best since 2010. And then last year we were down 12.45%. So that's something you want to look at. On top of gold and silver, I think it will be interesting. Again, there's a China story. It's about infrastructure. It's about expansion globally, inflation. I think we can take a look at COPEX, which is an ETF for copper mining. So it's a $1.66 billion company. So that's another reason. On top of that, of course, with electric vehicles and the global battery prices, I just want to look at is you can see how efficient we're becoming. It's almost like the chips and the computers. So that becomes efficiency, and that brings me to maybe looking at Lithium ETF or BATT, which is the lithium and battery technology ETF. I mean, lithium had a very good year, but again, it's an alternative. Look for corrections and maybe play that opportunity. I mean, it's a $5.34 billion under asset management. And I do remember I played this many years ago. It was very small. And here we are, $5.3 billion. All right. So we've gone from the fluctuations in the market, the volatilities, and talking about the commodities and the ESG. How about yields? How about looking for good investments that they actually have a high dividend? So there is this idea had come up, which is called dogs of the Dow. And what the dogs of the Dow looks at every single year on January 1st, they go look at, remember, there's a 30 companies in the industrial. They choose the top 10 with the highest dividends, and that's it. So those highest dividends, historically, they actually have beaten the other 20 generally. They've done better because of the high dividend paying. So here's the 30 of our members of the Dow Jones Industrial, and these are the top 10. So with their yields. So as you can see, Intel being number 10, and the Dow and Verizon being the top 2. IBM for some reason. Oh, here's the yield, sorry. Basically, these are the top 10s. So you have actually another list using this Dow, and it's called the Dow Small Dogs, the puppy, the Dow dogs or the Dow puppies. And those are the, out of these top 10, then they choose the cheapest, the lowest price, 5, which in this situation, you could see could be the Dow, Verizon, Walgreens, Coca-Cola, and Intel, and that could be another opportunity. So they pay, even if their 10-year notes go up. And I mean, we know even after 4 increases at the Fed rate, and then when they come and it goes to maybe 1% or 1.25, you still will get better dividends here. So we look at the valuation and the potential for growth. So this is just another idea. It's called, again, the dogs of the Dow. Also, I want to look at internationally, where are some of the best dividend increases in developed markets. And, you can see Australia, France, United Kingdom, Netherlands, and then ETH. They have had a nice growth in their dividends. Another alternative will be maybe playing REITs, and that's Vanguard has the VNQ, and you can see their performances. So last year they had a beautiful return, and then the year before they were down. So just look for another idea. I believe the last but not least, with the spreads, with the expansion of the interest rates going up, it's always music to the ears of the financials, and especially, financial centers, the banks, and which we've talked about middle of December, they usually start moving. So I thought to share some of those companies that they can take advantage of, really the increasing the yields. And basically that's would be, beneficial to all of these companies. So these banks, so just some ideas. In the meantime, there is an ETF called KBE, which is actually equal weighted index of the US banking firms. So that would be interesting. Or you can always play the largest one, which is the XLF with a $48 billion of assets under management, or IYF, which is a BlackRock. Okay, my goodness. Thank you so much. With that in mind, I hope it was helpful. I hope this is, again, something that we can build on. What I would recommend is this is the year to be selective. I think that alpha is not going to come easy. It's not going to be just passive investing, just put it there and leave it and just come back. I think you're going to have some challenges that it's important to to be aware of. So basically, I hope it was informative. I hope it gives you something to build on. And with that in mind, Sean, we can start recording and then open up for any questions that anyone has.